Welcome back to this monetary policy special. We have been speaking with the Executive Director of HDFC, V.S. Rangan, Head of Emerging Markets Economic Research at JP Morgan, Jahangir Aziz, Chief Economist at ICICI Securities Primary Dealer, A. Prasanna, Managing Director and Head of Fixed Income at HSBC, Manish Vadawan, and State Bank of India's Deputy Managing Director, Prashant Kumar. Well, Mr. Kumar, now to you. This big pushing the envelope in terms of market development, asking banks to link retail loans to external benchmarks. Will it handicap you because your cost of money is not benchmarked, but your low lending rates are going to be? Will you be able to manage this?
No, this is one area I think which we need to discuss and debate upon, because if you see the majority of our liabilities, they are from the deposit, they are not from the market. So in that scenario, like our deposit costs would not be having any bearing on our lending rate. So going forward, if our lending rates, and we are talking of the retail, which is almost like 60% of our balance sheet, and if they are linked to the external benchmark, then we need to see how we are going to manage the profitability part. But this is something which we need to discuss and come out with certain measures.
Okay, now I don't know if the NHB will follow suit. Logically, it should. Why should only banks be offering home loans linked to external benchmarks? What if the NHB follows, Mr. Rangan?
No, there are two, three. I agree with Mr. Prashant Kumar that, the liability side is relatively fixed for most of the players.
Yes. And
therefore, to make the asset side floating against an external benchmark is going to be a challenge. Having said that, the market, the most liquid market is probably the OIS market, and that also you have large liquidity in the 1 year and other segments.
That's right.
But the key issue is that a retail loan borrower, he may not actually understand a lot of these benchmarks and the way the volatility will happen in his interest rate would also be quite sharp, because today if you look at the MCLRs may change, let us say 4 times in a year, or maybe 5 times in a year. But if you really link it to the external benchmark, it can change almost every month, and also it can change very significantly over 1 month to the other month. So that is going to create a lot of volatility as far as the customer is concerned and his understanding is concerned.
Okay.
I can see one bright side in this is that typically for us, people may start offering fixed rate loans, 1 year fixed, 2 year fixed, or 3 year fixed, which can become more competitive or more attractive from a customer point of view also.
Okay.
So you may probably have, loan market coming back on a fixed rate basis. May not be for 10-year fixed or things like that, but ideally it could be a 1 year, 2 year fixed.
Fair enough.
Fixed type of market.
I somehow can never escape the feeling that I do feel cheated on floating rate products. They never seem to float. I mean, they rarely ever did when I had a floating rate loan. But let me come to the point where I was really irked. I mean, I know that there is something called this purity of principle, the Jan Tinberger rule, that you use one instrument for one target, or have as many instruments as you have targets. Jahangir, I mean, is this the only way to tackle this liquidity leakage and the purchase of bonds? 3.2 trillion or 3 trillion purchase, that's almost 60% or 70% of all the bonds that will be issued by the government on a net basis. Is there not another way to tackle this? This seems like practically monetizing the deficit.
Right. Look, so we can debate, the purity of the measure, but let's not forget that in the past, the RBI has regularly done this.
Yes, and they were criticized for it.
Time that, and so every time the government has become profligate, hasn't brought down its fiscal deficit on its own, sooner or later the RBI has come to its rescue This was done under previous governors. This is being done under the current RBI. And I don't really think that this practice is going to change until unless there is an actual Fiscal Responsibility Act or Fiscal Responsibility institution that curbs the hands of the government. So we can go back and forth on whether this is the right thing or the wrong thing to do, but this is something that RBI has consistently done every time. So just to give you a sense, back in May, I think we turned around and said that, look, this year is going to be one of the largest OMO purchases, given where.
But why not CRR then? Then why not CRR?
Well, I think on CRR, look, it is down to about 4%. So I think you want to keep some firepower.
Okay.
In the event something extreme happens.
Okay.
And I'm guessing that the CRR cut to them is seen as a more permanent way of injecting liquidity rather than these temporary injections of liquidity.
Fair point.
But I know, So
I guess if you are the government's merchant banker, you don't have much of a choice. Prasanna, what are your thoughts on this? Did they have another way out? Is this like kind of succumbing to the government?
Well, I think as an instrument, I guess you can say that open market operations are used by many central banks. I think the question is in which part of the curve you're intervening. So as long as the purchases are largely limited to the short end, I think it's fair. It's a fair practice. But of course, the problem in India, of course, is that the market trades only at the long end. So the RBI is forced to buy at the long end also. So there is definitely a moral hazard here. But I buy your point. I think what you're saying is if you buy up 75% of the borrowing program, then what are the fundamentals getting priced? Then it's purely a demand supply. So maybe I think one memo to Deputy Governor is he shouldn't come and lecture bond market and how we are not pricing risks, right? Whether it's inflation or fiscal deficit, right? Okay. Maybe they should look at the mirror themselves. And the second thing is, I think the lesson to be learned is that when RBI did OMO sales, if you remember last year, probably I think that was a mistake. So it looks like in India, anyway, currency leakage is fairly high, and the BOP situation is such that over the last few years, we usually end up on an average, we end up with a very minimal balance, so very minimal positive balance, which means that the FX route is not there for RBI on a prolonged basis for them to add reserves, which means that the OMO purchase is the only option. So I think the lesson to be learned is also not to do OMO sales, and then if you do that, I think the problem kind of gets doubled actually.
Yes, there is, but I guess at that time you can't see so much into the future. You probably think demonetization has worked and so much cash will not leak.
But that is their job, Lata,
yes.
But that is their job actually.
No, I take your point. I mean, I feel that this is simply too much of purchases, but I guess at this stage there isn't much that they can do till the end of the year. On the SLR cut, any thoughts, Manish? Will that have any impact on the bond rates, or will it be taken in the stride because of the overall dovishness?
Yeah, I think if you look at a bit of history, the SLR was at 19 or 19.5, but the overall SLR maintenance by the system is around 27%. So I really don't think there's any difference which is going to get made because of SLR cut.
Okay.
As you said, it would be taken in stride, and overall requirement of the system is far higher because of the LCR. And I would just take 30 seconds more to add one more point. What you were asking about liquidity, please see it in the perspective of what has happened in the last 1 year. The intervention in FX spot markets is around $30 billion, so it is approximately 2.1 trillion INR. The currency leakage is around 3 trillion INR in this year.
Yes.
So total, leakage of liquidity is around 5 trillion, and that is going from the balance sheet if you look at it.
Yeah.
And that is why this OMO thing comes up. So this debate of CRR versus CRR is, I think, quite a sanguine kind of a tool and for macroeconomic stability.
Fair.
I suppose they don't want to bring it down below a certain level.
Moral of the story, profligate governments should be happy when there is a run on the currency, because that will mean that the central bank will actually do more OMOs and help relieve their stress. Well, all told, I think the RBI would deserve a lot of kudos for this policy. The general takeaway has been that it has tried to be as dovish as it possibly could without putting the statement in black and white, thereby giving itself perhaps some elbow room in case there were ugly surprises either in the global rate cycle or in crude prices. It's been able to give a lot of comfort to the NBFC and the debt markets without doing anything unwarranted or unorthodox, like actually giving a line of credit, but almost coming very close to comforting the market. And finally, it has been able to push the envelope in financial sector development by trying to link loans to external benchmarks. Hopefully, the next experiment will be to link even deposits to external benchmarks. I would think that the RBI has come out with flying colours under the circumstances. Thank you very much, Prasanna, Manish, Mr. Prashant Kumar, Mr. Rangan and Jahangir for joining me in this conversation.